So let's talk about the difference between stocks, ETFs, index funds, and mutual funds. Let's dive in. So these four assets really fall into two categories. Category one would be stocks or individual businesses. Category two would be bundled products, and that's what ETFs, index funds, and mutual funds fall into. Now, with the two categories, you have two strategies. Strategy one would be wealth building, and strategy two would be wealth protection. Stocks are great for building your wealth. The reason is when you hold a portfolio, and this is what we recommend, a portfolio of about 10 to 15 stocks, that's when you can earn returns that are 15% or more in the market. In my case, I've been using Tykr for about 8 years. My returns are closer to 50% consistently year over year. Sometimes it's more, sometimes it's less, but individual businesses allow you to accelerate your wealth building process. Now, if you're in wealth protection mode, let's say you're nearing financial independence or nearing retirement, or maybe let's say you sold a business, sold some real estate, or inherited some capital from a loved one. In that case, move towards wealth protection mode. That's when you can look at those ETFs, index funds, and mutual funds. Now, when you invest in bundled products, a good benchmark to look at is the S&P 500. Over the last 10 years, the S&P 500 has returned about 13% per year, whereas over the last 20 years, I think it's closer to about 8%. But I usually tell people, if you go into a bundled product, you should be expecting about 6 to 8%. But again, your goal is not to build your wealth, it's to protect it. Now let's talk about the difference between ETFs, index funds, and mutual funds. So ETFs and index funds are very similar. ETFs stand for exchange traded funds. And what you can do here is you can buy ETFs midday and you get the price you buy it for, whereas with index funds, you get the end of day price. So here's an example. Let's say it's 1 p.m. on a Tuesday, you're going to buy an ETF for $100. The moment you buy the ETF, you get the price you buy it for, whereas with index funds, you have to wait to the end of the day. So let's say it's an index fund. It's 1 p.m. on a Tuesday. You go and buy that index fund at 100, but the price goes up to 102. And in that case, you get the index fund for $102. It's not a big deal. When you're investing in these bundled products, your goal is not to trade or make short-term gains. Just pick one, move forward, and commit for the long haul. You're going to be buying something like this and committing for years. It's not something you buy and hold for a few months and try to sell it for a profit. Now let's talk about fees. Fees are what really separate these four assets from each other. So I'll go ahead and share my screen and let's take a look at some of the fees. So there's two major fees to pay attention to with these products. You have expense ratio and you have AUM. Expense ratio is the cost to hold that product per year. And AUM would be the service fee. If you're working with a financial advisor or wealth manager, you're going to pay them an AUM fee, which is assets under management. With stocks, there is zero expense ratio. You can buy any kind of stock you want, you can hold it, and you're not going to be charged anything for holding it. Of course, your broker may charge you a small fee. Some brokers are free, but that would be your transaction fee. But expense ratio is zero on stocks. Now, with ETFs and index funds, the expense ratio is very similar. With ETFs, it's about 0.1%. It can be a little more, sometimes a little yes, but that's a nice even number to look for. And then with index funds, it can be about 0.2%, which is pretty close to ETFs. And of course, it can be a little more, a little less. When you get to mutual funds, that's where expenses get a little higher. I've seen mutual funds that can be 2% or more, sometimes 1% or less. In this case, I have 1.5%. And then usually with mutual funds, you need to buy those through a financial advisor, wealth manager, or mutual fund manager. You typically don't buy those on your own. In some cases you can, but it's usually through some sort of advisor. If you're looking to protect your wealth and you want the bundled products, I say gravitate towards the ETFs and index funds because your expense ratio is a lot less. Now let's dive a little further into the expenses and how they can impact your portfolio over a 10-year timeline and 20-year timeline. So looking at my screen, you can see we're going to start with $5,000 into my broker, and then I'm going to contribute $6,000 a year. So I'm making a $5,000 investment, contributing about $500 a month, and then my annual return is 15%. We're going to use 15% on stocks, ETFs, index funds, and mutual funds just to even the playing field so you can see what kind of fees you're going to pay with each of these bundled products. And in this case, we're using 10 years. So let's go ahead and unhide these rows. So over 10 years, I start with a 5,000 investment, contribute 6,000 a year. My portfolio will be 142,000. With ETFs, it's going to be 141,000. I'm going to pay about $768 in fees, which isn't too bad. Then you get to index funds, 140,000 versus the 142 with stocks, which is pretty close. And in that case, you're paying about 1,500 in fees. This is where things get a little interesting with mutual funds. Your portfolio is not 142,000, it's 124,000, and you're paying about 17,000 in fees over 10 years. So you can see here, it's quite a bit more expensive for pretty much the same returns. Now let's dial these numbers up a little bit. We're going to start with 10,000. Annual contribution is, let's go 12,000. So we're investing $1,000 per month. We'll keep the annual return at 15%. We'll move the years from 10 to 20. And here's how things look. So over 20 years, your portfolio will be 1.3 million with stocks. With ETFs, it will also be 1.3 million, but you're paying about 17,000 in fees. Index funds, also 1.3 million. You're paying about 34,000 in fees. Now, this is where things move from interesting to quite alarming when you move to mutual funds. So over 20 years, instead of 1.3 million, you'll have 1 million. You'll pay $371,000 in fees. So this should give you a pretty good idea of the differences between stocks, ETFs, index funds, and mutual funds. You can see that with stocks, great way to build your wealth, protecting your wealth. Of course, we know you're probably not going to see those 15% returns with ETFs and index funds or even mutual funds. But in this case, you can see what the fees look like. Now, with wealth protection mode, I would recommend moving more towards ETFs and index funds because your fees are a lot less. I really only recommend you stay with mutual funds if you already invest in them. If you really like your advisor or your wealth manager, if they're giving you peace of mind during tough times like we went through in 2022 when the market was pretty much tanking. In that case, yeah, stay with your mutual fund manager. They can give you that peace of mind, help you sleep a little better at nights. But if you're thinking, I'm really paying a lot in fees, ask them if you can move towards a lower cost mutual fund or maybe even move towards an ETF or index fund. Of course, you can go to your own broker as well. In my case, I use TD Ameritrade, and I could, anybody out there can go and buy an ETF or index fund. Okay, so hopefully that gives you context and the differences between those four assets. You have strategy 1 or category 1, which would be wealth building. And then you have strategy 2 or category 2, which would be wealth protection. That's where you have those ETFs, index funds, and mutual funds. If you like this video, go ahead and hit that like button. If you want to see more like it, hit that subscribe button. And if you want to learn more about investing, go ahead and check out Tykr.com. You can join for free. We'll see you in the next video. Bye for now.